Imagine owning a slice of a skyscraper in Manhattan without ever signing a mortgage or unclogging a stranger's toilet at 2 in the morning. That is basically what a real estate investment trust, or REIT, lets you do. Think of a REIT like a playlist, except instead of songs, it holds dozens of properties, and instead of streams, it pays you dividends. Someone bundles up shopping malls, apartment buildings, hospitals, or warehouses, sells you a piece of that bundle, and boom, you're technically a real estate mogul in your pajamas. Here is the part that makes REITs genuinely weird and kind of wonderful. They trade on the stock market just like shares of your favorite tech company. So you can buy in for the price of a fancy lunch and sell by the afternoon if you change your mind. Compare that to actually buying a house, where you need a down payment, a loan, an inspector, a lawyer, 3 weeks of anxiety, and at least one crying session in a parking lot. REITs skip all of that completely. Now, here is something most people do not realize. By law, REITs are required to pay out at least 90% of their taxable income to shareholders as dividends, which is why they tend to be income-generating machines that investors genuinely love. That rule exists because Congress created REITs back in 1960 to give everyday people access to large-scale real estate investments that were previously only available to the ultra-wealthy. So yes, this was basically the government saying the rich kids cannot have all the nice toys. There are a few different flavors of REITs worth knowing about. Equity REITs own and operate physical properties. Mortgage REITs deal in the loans behind those properties. And hybrid REITs do a little of both, like the overachievers of the REIT world. You might already be indirectly invested in REITs through your retirement account or a mutual fund without even knowing it. That is either comforting or slightly unsettling depending on how you feel about surprises in your financial life. One thing that trips people up is the relationship between REITs and interest rates. When interest rates rise, REITs can struggle because borrowing becomes more expensive and their dividend yields look less attractive compared to safer options like bonds. So REITs are not a set-it-and-forget-it situation. They breathe with the economy the way a souffle reacts to someone opening the oven door too early. Timing and context matter, even if you are just a passive investor sitting on the sidelines. Diversification is another big selling point here because a single REIT might hold properties across dozens of cities, sectors, and lease types. That means one struggling shopping center in Ohio is not going to tank your entire investment the way owning that one actual property would. Liquidity is the underrated hero of this whole conversation. You cannot call up your landlord and say you would like to sell your apartment by Thursday, but you can absolutely sell your REIT shares on a Tuesday morning in about 4 seconds. The honest caveat is that REITs are not risk-free, and a bad real estate market will drag them down just like it drags down property values in general. But as a starting point for someone who wants real estate exposure without committing to a second career as an amateur landlord, they are hard to beat. What makes REITs so interesting is how they democratized an entire asset class that used to require serious capital and serious connections to access. Now you can own a fraction of a data center, a hospital, a storage facility, or a hotel chain, all through a simple brokerage account. So, if you have ever looked at a gleaming office building and thought you want a piece of that, but I do not have $40 million handy, REITs were basically invented for that exact feeling. And if you want to learn more about how we help people navigate investments like this, check out the links in the description.